All right, welcome everyone. Episode 33 of the Wide Lens podcast, and I am joined here with my fresh co-host, John Sim, and we're going to cover the latest and hottest topics in financial markets this week. We're recording on Friday, the 17th of February 2023. John Sim, welcome to the podcast.
Thank you. Good to be here.
All right, I'm looking forward to this. We don't have headphones after trying to wipe the cobwebs and dust off the dock and mics. We've misplaced the headphones, but we should have them next week. So let's get straight into it. I want to quickly wrap up with, I might start with this chart here, which is the S&P 500, the ASX and the European stock market, S&P 500 in orange, the Aussie market in purple, and the European market in green. What's been really surprising for me is Q4 of 2022, how like markets just turned around and bottomed out in, I think it was the 1st or 5th or 6th of October or something like that, and running pretty hard since then. But having a look at markets, if we just look at how markets have been going this calendar year. So I've just done this chart from 1 January 2023. What's been really surprising to me is the European stock market up almost 7% just for the month of January. European market's always been, for many years, as far as I can remember, just a laggard relative to that of like the US and Australia, for example. The Aussie market's up about 4.5% for the month of January, and the US stock market up about 6%. But it wasn't until a couple of weeks ago, the US market was pretty flat for the month of January until we clicked February, and then you saw the US market really start to rally and catch up to the rest of the world. So that's kind of what's been happening through the month of January. We're going to talk a lot more about some of this stuff in a bit more detail shortly. The other interesting chart I want to bring up from Deutsche Bank is this total return performance of major global financial assets in January 2023 versus that of financial year 2022, or the calendar year in US for 2022. And have a look at basically every single, except the commodities index on the right-hand side. I think it might be flat. But everything was down in 2023 and looking pretty damn strong in 2022, and looking really damn strong in January of 2023. Whether it's going to continue or not, we'll talk a little bit more about that later on. A few observations that I might just read these, if that's okay. These are some stats that Bespoke published the other day, and I thought it was quite relevant. I'll just start reading these, and listeners just listen in. A good start for the S&P with a gain of 8.5% in the first 25 trading days of 2023. The S&P 500 had its sixth best start to a year since 1953. So post-World War II, sixth best start. When the current 5-day trading week began, over this 70-year period, there have been 16 other years where the S&P 500 rallied 5% or more in the first 25 trading days of a year. 16 other years, and the median rest of the year performance was a gain of 17%. So the rest of the year, the S&P 500 gained another 17.6%, with gains 15 out of 16 times.
Wow, that's some good
What's
stats.
that as a percentage? 15 out of 16. You're smart. I mean, a quick,
Like the calc.
quick 15 out of 16. And 94% of the time, it was positive. The only exception was in 1987 when the S&P 500 started the year with a gain of 16.1 and traded down 12% for the rest of the year. Even better for the NASDAQ, since its first full year of trading in 1972, the NASDAQ's 15.7 gain in this year's first 25 trading days ranks as the third best, behind 1975 when it was up 18% and 1987 when it was up 16%. In the 20 prior years that the NASDAQ rallied 5% plus in the first 25 trading days of a year, the index's median rest of the year move was a gain of almost 12%, with gains 85% of the time, 17 out of 20. For all other years, the NASDAQ's median rest of the year move was a gain of 6.5%, with positive returns 66% of the time. And finally, What about Europe? Europe's benchmark stock 600 rallied 8.5% in the first 25 days of 2023, which was its third best start since 1987. In the 7 prior years when the index was up 5+% over the first 25 trading days, its median performance for the remainder of the year was a gain of 10%, 71% of the time. In all other years, the median rest of the year performance is a gain of 7.7% with positive returns almost 60% of the time. So if everyone's sort of wondering whether or not this rally is gonna stick, it's hard to tell, but it seems to me like those rallies that we've seen through, we had one in June, July, we had these mini bear market rallies. They didn't stick for long, but this one's been running for a good 4 months now, and we'll talk about this a little bit more, but even with CPI and employment data coming out of the US this week, markets look like they're shrugging that off and really starting to, I feel like there's this tug of war between investors, whether or not the data's a good thing, the data's a bad thing, whether rate hikes are a good thing or rate hikes are a bad thing. But if we look back in history, good solid starts like we've seen in the month of January, I mean, no one's got a crystal ball, but looking at these things probabilistically, the odds are pretty high for a solid year ahead. But don't trade that.
Do you think though that there's a number of different macro circumstances from the past, call it 20 years, that are evolving in the market with, obviously the change in the rate environment that's going to impact on that probability as well?
So some of these things go back to, so the S&P 500 one went back to like post World War II. And if you think about post World War II, like since then, how many times have we seen really high interest rates climbing from lower levels? Off the top of my head, I don't know, but I would guess that there would be number of periods whereby we've gone from low rates to high rates and high rates to low rates. But interestingly, the correlations, I don't think from memory are that strong around, depending on where rates are. Yeah. I mean, you look at the 80s, I mean, markets seem to do okay during them when you had really high interest rates. I mean, the other thing is that, do you remember back in 2021 during the when tech was just going gangbusters, everyone was saying tech's different this time because of blah, whatever the reason was. It's different to the tech wreck. It's different to this is going to sustain and we're going to keep going. Like then it literally got punched in the face with 2022, markets down. I think the NASDAQ at peak to trough was down like 35%. I can't remember exactly what it was. So I don't know, like I feel like in the moment it's easy to say that, but inevitably, I don't know, I find inevitably markets revert back to what kind of they've always been doing. Whether the trigger to get it back to what it was doing was something different, I don't know.
Well, the probability remains pretty high then.
But like if that's all we've got, right? If it's post World War II, you've got 70 years or 75 years of interest rates high, interest rates low, inflation high, inflation low, tech going gangbusters, tech not going gangbusters, growth stocks, value stocks. I don't know. I feel like that's a pretty good yardstick of like what investors could expect. I don't know. I just feel like it's a game of odds, man. Like no one knows what the future is going to hold. And so if you're playing with odds, it's not like the casino where every hand or every roll of the roulette, what's that called? The roulette wheel. Yeah. It's got like a certain percentage, right? Yeah. Like it's not like it's a 50-50. It's going to be, every time it spins on a red or a black, well, unless you got double zero now. But before they bought double zero in, you had zero. Yeah. Zero was never red or black. But in the absence of that, it's 50-50. But I don't think the stock market kind of works that way. Anyway, look, that's kind of a quick catch up of what's been going on throughout. I mean, there's a lot that's been happening, but if we just look at how that's reflected in the stock market, that's what the markets have been doing. I feel like it's caught a lot of like market commentators off guard, and I feel like that's why most people are saying that this is just a bear market rally. But I don't know, these are the facts. These are not numbers that I've made up, and this is what it is.
As Howard Marks says, you can't just be right. You've got to be contrarian, right? And I think a lot of people have gone contrarian.
Do you think everyone's gone contrarian?
Well, a lot of people are capturing this. This.
All right, I've got a couple of charts for you, which might shoot that down. All right, I'm going to take the first topic today. So the last couple of days, in particular, we're starting to now hear more of from hard landing, soft landing to now effectively a no landing. And so I was really curious about what a no landing meant, but let me kind of just set the scene up for us now. I'll just bring this chart up now. This is inflation, currently sitting at 6.4% annualized, unchanged from about a month ago. But if you look at this chart, like we saw at the back end of year through October, month-on-month inflation in the US peaking, and you saw it coming down again, and we saw inflation coming down from its 7 or 8. I can't remember exactly what the inflation rate was. But now look at that month change.
It was 7.8, but yeah, month-on-month change. It's big.
So we had this downtrend, and now we've got this little kick that has almost, I feel like, caught most people off guard, because there was talks of the post-COVID logistics, transport, all of that being unlocked or unwound or undone. But a lot of shelter and housing is starting to push up inflation at the moment. The other important data point we had, and I'll bring this chart up now as well, was employment in the US. This number just
ripped up.
Totally baffled me, right? Like you've got all of these headlines being made at the moment about how all these companies are laying off and the employment situation is not good. And then you get these non-farm payrolls in the US, like almost nothing we've seen. I mean, barring what was that, July in 2022, and prior to that, the beginning of that year. But since then, we haven't seen a number anywhere like it. And all of a sudden, people have still got cash in banks. When you look at deposits with banks, people are getting jobs, and so it's no wonder that the inflation number still is becoming is stubbornly high and persistently high. A slow downward trend, but it's nowhere near what people would like it to be.
Yeah, and I feel like there's still quite a disconnect between business confidence and
what
and this sort of information that you're seeing in terms of strong unemployment data.
What do you mean? Like people are saying that things are bad?
Yeah, they're saying that things are bad. We've got some good data to back that up in terms of business confidence, and as we had in our Econ Capital report, business confidence was at all-time lows, but people were still heavily invested in equities. So,
but do you think that's because do you think it's because what the media is portraying? I mean, I just read last night Fidelity's hiring 4,000 new employees, most in the US. Like, mate, you don't hear that in mainstream news, right?
No, that's right.
All you hear is, and I'll bring this next chart up, this is from Yahoo Finance, tech companies laying off workers after pandemic hiring sprees. So you're hearing of all the recent layoffs announced: Microsoft 10,000, Google 12,000, Salesforce 7,000, Amazon 18,000, Meta 11, Spotify 590. But have a look at the pre-pandemic headcount growth. I mean, just look at Amazon, man. That is mind-blowing.
Yeah.
750,000 almost in headcount, and we're crying over an $18,000 cut in headcount. Like, get the fuck out of here, man. What are we talking about, right? So I don't know. Maybe what the media is telling us is a way that we're supposed to feel.
Yeah.
And that's what we're supposed to say. Yes, I'm not, my confidence the future is not good. Hey, but I'm still holding my equities. And so, yeah, you got to disconnect between what people are actually doing and what people are actually saying. And there's a lot of data that supports the fact that there is a huge disconnect. Talking about advertisements, interestingly, that's US. I'll bring this chart up now. This is Aussie. Job advertisements are coming down in the US. Australia's still seems to maintain the job adverts levels at the moment. If I was going to bet, I'd say that's probably going to come down.
Yeah, we usually lag the US a little bit.
So we've got that. I'll bring this next one up as well. Australian retail sales. This is the big one we saw. But having said that, I feel like since the pandemic, look in this chart how stable Aussie retail sales have been since 2005. Pretty non-volatile, relatively speaking.
Yep.
And then you hit the pandemic and shit's all over the place. Like you can't. I feel like you can't make heads or tails out of that. But clearly that's interest rates are having a big impact on people spending. Their confidence, but people are still, holding equities. Obviously, I haven't got. I know you're going to talk about some property, but I haven't got any data in front of me to show with property sales, but stock is low. So I do think there is this disconnect between what people are feeling and what's actually going on. A couple more charts here. Australian unemployment rate. It's been going up since October, and the US has been going the other way. And so I feel like there's, everyone's talking about Australia, the lucky country, we're going to escape a recession again this year, or whenever it might be. I don't know. The sort of leading indicators don't indicate that all if you're comparing that to the US. And then finally, property prices, annual change. You and I have looked at this numerous times. I mean, these are some big declines in 1 year changes. Sydney down almost 14%. Melbourne, the other big one, down almost double digits now. Look, the rest didn't go up as much as some of the other cities, but aren't coming down as much either. But, these are having massive impact on people's situation and circumstances. And so with all of that going on, you then get this retail sales number coming out of the US, I think a couple of days ago, and it's like nothing we've seen since 2021. The 3% rise on retail sales. And so you've got strong retail sales in January. The consumer's clearly not slowing down. You've got a strong labour market, strong wage growth, and savings, a high savings rate across most groups. Quote this from Apollo: incoming data from airlines, hotels, restaurants, movie theatre visits and Broadway shows continue to be strong, and consumer services are not slowing down. And with retail sales mainly measuring goods consumption, the bottom line is that even consumer spending on goods will continue to do well. And so with all of that as the backdrop, this whole concept of interest rates are going to go higher and higher and higher, and it's this doom and gloom. The reality is that the market was and has been expecting this doom and gloom scenario, and we're going to have a hard landing. But maybe the central bank can corral things and massage things, so we have this soft landing. But potentially we're now talking about a no landing scenario whereby the regime looks like actually resilient growth and higher inflation for longer, higher interest rates for longer.
Systemic inflation is what you're potentially saying.
We just sit here for a prolonged period of time.
Yeah, it'd be interesting if the the RBA and other central banks allow that to happen. I mean, that's sort of
allow what?
Systemic inflation, right?
Just letting it sit higher.
Yeah, letting it sit higher. I feel like they're not going to let that happen. It's harder to get rid of systemic inflation than it is to sort of take that medicine now and sort of bring that back down. So that'll be a really interesting one.
Why is it a bad thing to have inflation at 5 or 6%? What's so bad about that?
Well, that's the growth rate. So that's the growth rate of inflation, and that makes it really hard from a household perspective to maintain a good quality and high standard of living, isn't it?
But we're doing it now. People are still spending. They're travelling.
Yeah, but we look at that headline rate and it's the growth rate. So if it keeps growing at 5%, it's exponential.
What if it doesn't keep growing at 5%? What if we have...
Well, the target's 2 to 3%, isn't it? So
yeah, I see what you're saying. So we're not saying prices are we're going to have disinflation where prices are falling, or we don't have deflation.
Have a moderated price growth to a level that's sustainable.
Yeah. So what was the number? 0.5%. I mean, if you annualize that, that's about 6%. I think what's going to be interesting is the month-on-month change from now on. I think looking at annualized numbers, like you're drunk. Don't look at the annualized numbers. It's really meaningless. I think what we need to start looking at is just this month by month and seeing how the consumer and how the economy is digesting what's going on.
Yeah.
Do you want to add anything else to the whole soft landing concept?
No, I think look, there's so many drivers and variables that need to be looked at, right, by these central banks in order to work out whether they keep pulling and pushing the levers. It's a really hard thing to predict what they're going to do, right? And even Philip Lowy got it wrong when he said, "Oh, look, we're going to leave rates lower for longer," and look how fast he sort of adjusted his view.
Remember when Australia wasn't raising interest rates until 2024?
Yeah, exactly.
It's like 0 to 100.
Yeah,
like, what's going on, man?
Even the best minds are just moving with the variables as they see more of the data coming in. So it'll be really interesting to see that play out.
Let's move on. What do you want to talk about?
Probably let's look into my favorite topic, the residential property market. And
everyone's favorite topic?
Everyone's favorite
Everyone's
topic.
a guru in property, right?
That's right.
Everyone's a property developer.
Yeah.
Someone does a renovation. They're an expert.
100%. And look, a lot of Australian household equity and wealth is locked up in their homes. And so understandably, it's a major concern. There's a number of factors, you touched on inflation that's playing a big part in property prices at the moment and what the central banks are doing around increasing rates and how that affects property values. So, it's a really interesting state of play that we've got where, as you're saying, in December we had, the sharpest annual rise in CPI growth at 7.8%. And that's remained systemically, pretty high. So central banks are really trying to control that amount. And, we're seeing signs of that inflation moderating, I think, as well in energy prices,
100%,
supply chain issues being sorted out, as rates continue to rise, we're going to have tighter financial situations at home, which are constraining spending, right? Interest rates going up means higher mortgage payments, which means people have got to cut back. So I think that's going to start playing through from on the home front, we're already seeing many articles about families struggling with cost of living, having to cut down swimming lessons and just focus on basic needs effectively to get by and
in Australia.
In Australia, yeah, I saw that article the other day.
But I mean, you can just look at the retail sales. Like that just is down off the charts in the wrong way.
Yeah. And
because people will preserve the house.
100%.
That is the last line of defense. And so
it's the castle, isn't it?
100%.
Yeah.
100%.
So that's a really interesting dynamic going on. Reserve banks continue to, as we said, try and bring down inflation to the long-term average of 2 to 3% to ensure there's no systemic inflation. And I'm feeling like especially looking at your employment numbers, there's still a really tight labour market and really
100%.
Strong wage growth. And it's going to really take time for, inflation to really moderate and decrease substantially based on just people's confidence.
And so do you think then that whole no landing scenario is one that is possible, whereby we have this period of we're not going to, I mean, everyone thinks about things in a binary outcome. Why they're going to boom or going to crash, crash and burn. And so they're just the two outcomes that we have. Could it be all possible that actually we do muddle our way through and we have this Goldilocks perfect scenario whereby we do manage to get through it because we're spending so much time, they're saying it's the most anticipated recession in history. And so if everyone's so aware of it and we're so prepared for it, don't you find that it's just one of those things that just never happens because you're so...
Potentially. I'm of the view that it's going to be delayed. So, we're going to have...
Yeah, but a recession's inevitable. Like,
it's
we're
inevitable.
always going to have a recession.
Yeah, we're always going to have it. It's just when.
But that's the thing. No one
knows.
We can all agree there will be a recession.
Yeah.
But who the fuck knows when?
Yeah, that's right. So is it going to be this year or next year or 2025?
Who knows?
Yeah, who knows? But you're right. It's sort of this limbo period in the cycle where, potentially we hit a longer period of this Goldilocks period before we come back down.
Sure.
Right?
But it could be that financial markets could boom, as we have seen. I mean, you look at the Spanish flu of the early 1900s.
Yeah.
And, you look at what happened after lockdowns there. You had travel booming, entertainment booming. It's like the history is kind of, repeating or rhyming, whatever you want to call it. But, that market boomed for a long time, for a further 10 years.
Yeah. Yeah, 100%. Yeah,
and you had high inflation and came down. Maybe it could be possible that we could have a huge run up, and then sure, we'll have another recession. Market will come down. But let's not forget, financial markets fell 20 to 30% last year. Like, that's not an insignificant decline. It lasted for about a year, and it feels like, I feel like everyone's forgotten about that already.
100%.
Don't you think?
Yeah, 100%.
Like maybe
people have short memories.
Maybe we've had our recession. Maybe it's not like a technical recession. Maybe we had our, cleansing done for 2022.
Let's hope so.
But then, John, what happens to the people that are sitting on the sidelines waiting for, whatever tea leaves they're reading?
Well, that's right. That's another big issue. I feel a lot of capital sitting on the sidelines waiting for something, a bigger discount to be had.
What are we waiting for, man?
Well, another crash. And that brings me to my next point. So, is there any relief in sight for interest rates? RBA recently increased their cash rate by another 25 bips to 3.35. Most of the major banks have passed that through. And, the central banks acknowledge that there's, these cumulative interest rate increases. There's a lag effect
100%
to when they're going to be felt. And, like we'll bring up an article in the AFR today. Lowy warns on 350 billion fixed rate cliff. I mean, that's a massive amount. If you look at CBA's full year report for 2022, they reported 75% of the mortgage book exposed to rate increases through June 2023. They've got $51 billion of fixed rate loans rolling off in 6 months to December 2023. 44 billion in the preceding 6 months and 29 billion in the first half of 2024. So, most of the major banks, they've got a lot of their customers that are definitely going to roll from a fixed rate of, call it 2%, to a 3 to 4% point increase in their borrowing.
I thought you were going to say to a 3 to 4% interest rate. No,
increase.
It's like 6%.
Yeah, 6%. So 2 to 3 times what they're paying. If they were already stretching their serviceability requirements last year when they're borrowing, 80, 90% no LMI or 90, 95% with LMI, and suddenly you're moving and you're already stretched at that point, we're going to see potentially, a fair bit more trouble coming through. I haven't looked at bad debt provisioning, but it'd be interesting to see how much the banks are increasing that to take into account the fact that they may see... Well,
ANZ's raising a bit of capital through subordinated notes,
the
hybrid
note.
Securities.
Yeah.
So, what's all that about? Capital management?
Capital management. I mean, banks still need to grow their books, right? Their investors demanding that they're going to keep growing and keep growing revenue, which means that, they're just going to have to keep building up that loan book or building up margin. So... yeah, it's a really interesting situation. And, if property prices are intrinsically tied to basically inflation and what the RBA is going to do, to get their target inflation rate back down, I'm seeing 2023 to be kind of a year of transition where, economic conditions may be stabilized due to some macro factors, but then, we'll see another couple of rate hikes and then potentially the RBA holding when inflation starts dropping. But ultimately that flows down to property valuations, right? And property prices, limiting borrowing capacity. Because
100%.
Yeah, and we're already seeing it. Borrowing capacity for borrowers is down, sort of call it 30%. Compared to last year.
Yeah, I was going to say someone that could borrow $1.3 million now can only borrow $1 million.
Yeah, exactly. And I'm hearing many stories around the market from brokers, and they're sort of pulling their hair out. They've got plenty of clients coming in to, come in and refinance their loans. They're rolling off fix, and suddenly, banks are going. These brokers are going, shit. How are we going to get you another loan at the same amount? You're going to have to reduce your leverage, or you're going to have to sell, or banks are going to say you're going to have to rapidly amortize your debt right back down to ensure that you're not in any financial difficulty.
I agree that those factors are so obvious to everybody. And I don't know, maybe call me naive, but I feel like the fact they're so obvious, the risks, in my humble opinion, are the things that no one sees, right?
One sees, yeah.
I read an article, I think last night or the day before, Bloomberg published an article. I think it was B of A talking about, what are the tail risks? And like someone's talking about inflation. Like, I'm like, come on, man, how is that like a tail risk? So I'm thinking about tail risk being, I don't know, the pandemic was a tail risk, right? The GFC was a tail risk. The fact that we've got a fixed rate cliff coming up in December, we all know what's up. Like the RBA knows that. I'm sure industry consults with Treasury. I'm sure the other way around. They know the data. They know what's going on.
Oh yeah. I caught up with Westpac's management a couple of months ago, and even in that meeting, they were already having meetings with APRA to talk about covenant breaches and wording APRA up in terms of, hey, we're going to see some massive valuation drops. How are we going to deal with this, right? And yeah, it's really, really interesting. So yeah, look, everyone knows it's coming.
And so I feel like for that reason, I'm like, someone will deal with it. I don't feel like it's this risk. But your comment about breaching covenants, like banks aren't going and revaluing properties.
No,
right? Like imagine if they did that, it would be suicide.
Yeah, they'd be killing the golden goose.
Yeah, 100%.
Because it lays the golden egg.
So
right? So everyone's incentivized to ensure that there's stability in the market to a certain extent. So I think a lot of these issues will be dealt with, but there's probably going to be a proportion of those that are higher risk that the bank just goes, hey, look, we don't want to take that risk on. You're going to have to refinance.
What happens? Do you remember back 5 or 6 years ago? We've talked about this before, where we had where APRA were mandating that banks can only have a certain proportion of their loan book with interest-only loans. Do you remember? And then there was the interest-only cliff.
Yeah.
And then that was coming up for expiry, and all these loans had to go to P&I. Like, what the fuck happened with that? Nothing.
Well, there was big changes in the banking world.
What happened?
They moved all their clients to P&I. So they just started writing less interest-only loans. So naturally the proportion shifted, right? And they increased the serviceability requirements too. So, they put that up, if it was, call it 4% servicing of an interest P&I loan, they bumped that up by another 2% to 6%, for example.
What type of transitionary mechanism do you think could be possible in this situation where you've got 40% of loans maturing, 40% of fixed loans maturing in, I don't know, the end of the year? Like what can the banks, if interest rates are where they are, and you've got what's a home loan now? Like 4.5%, maybe
5.5%, yeah.
5.5%?
Yeah. 5.5%.
You go from 2 or 3 at best, and it's almost double.
Yeah.
Like what happens?
I mean, I'm no longer sitting at a bank. If I was in there, I could tell you. But I mean, what I'm hearing in the market is that people may be faced with a situation where they might have to sell, and or find another way to scrimp and save to be able to continue to service, or not refinance. Because a lot of people, in the last couple of years that I know, have been refinancing to try and get the best rate, right? So you might just go, well, let's leave it at the higher rate, keep paying our interest payments, and continue on.
Tighten the belt. No more swimming lessons.
That's right. No more swimming lessons.
Yeah.
So yeah, it's really interesting. But for context, if we're looking at some data from say CoreLogic, national home values fell 5.3% in 2022. Sydney property prices led that loss among capital cities, falling about 12.1% on average. Melbourne at 8.9%. And, despite those falls, if you look at average capital city prices, they remain 11.7% higher than pre-pandemic levels. And regional values are still up 32.2%.
That's interesting.
Yeah. And for context, over the last 10 years, national dwelling prices are still up 60.3%.
Yeah.
So, so long as you hadn't bought last year, you're still sitting pretty.
Yeah.
Unless you've gone and refinanced and leveraged up your property, right?
Mm. So do you think it's more of a management of expectations and people kind of having to have their big ego killed that their property's no longer worth, $2 million? You thought it was. It was a year ago, but it's actually worth 1.8.
Yeah, that's right.
You just got to swallow that pill.
That's right. Yeah, so I think in terms of prices, probably a little bit more pain to come to the end of the year until we start to see a stabilising in rates and inflation. And then hopefully, strong trajectory into 2024 because, a lot of, new home builds and new apartment builds, aren't coming online due to a huge number of factors, construction costs going up, pre-sales, all 100%. The rest of it, we're going to start seeing some undersupply, and immigration's coming back.
That naturally causes a problem.
That's right.
It's just so many forces. It's almost like undercurrents. You got current moving this way, you got a current moving the other way. Doesn't know what's going on.
That's
right.
And
I think that's what paralyzes investors is just the inability to make a decision and run with it, regardless of what the outcome is going to be. I mean, I think we just crave certainty and crave control. You just can't get that with the market. And if that's the game you want to play, then they're the rules you got to abide by. Do you want to chat about anything else, or should we move on?
No, let's move on.
Bloomberg had this article, B of A survey shows investors expect stock rally to fizzle out. So that's what we were talking about before. Yep. So what Bank of America Merrill Lynch do is they go and survey their investors and they have this report. So what we've been seeing is stocks on an absolute tear since Q4 of 2022. US has been lagging its peers up until the last couple of weeks. And I wrote down, I said, good news was bad, then bad news was good, and all of a sudden good news is good again. And it's just this market trying to work out what all of this actually means. According to the report, most investors aren't convinced the gains will last, according to Bank of America Corp's latest Global Fund Manager survey. Listen to these stats. About 66% of participants in the bank's February survey said stocks are seeing a bear market rally, signaling they expect them to return to new lows. If they interviewed you, that might go to 67%.
Yeah, that's right.
That's even as the shares of investors expecting a global recession fell to 24%, down from a peak of 77 in November. So almost 2/3 of respondents were expecting a recession. Now you got a quarter.
Wow.
Pessimism around economic growth is at its lowest in a year, while 83% of fund managers see inflation easing over the next 12 months. I want to share a couple of charts and let's talk about your contrarian point of view. The first one is net percentage overweight equities minus net percent overweight bonds. And so effectively investors on the bottom right-hand corner there are overweight bonds at the moment. And what was really interesting to me was, and you can see that little kick up now where equities are now starting to turn. Yep. But what's interesting to me is you look at March 2009 and May of 2020 when we've seen, big disparity between asset allocation and what has subsequently happened in those two, and this will be the third, extreme moves in asset allocation for the last 22 years is market went on absolute tear post-GFC of March 2009. And May of 2020, we saw obviously with the most recent one with COVID and the pandemic and the stock market rally following that. That's the first one, and I'm curious to get your take on it. Second one is investor risk appetite. What level of risk do you think you're currently taking in your investment? and basically we are at absolute in the doldrums. People are taking on less risk than they were back during the GFC.
Yeah.
One of the biggest global financial crisis in the last 100 years, where we had major institutions around the world literally collapsing, and investors are more taking on less risk now than they did back then. And so with all of this in mind, and you talk about contrarian, I feel like contrarian's going the other way. The other way to what how the respondents are responding to this survey. Again, I'm only looking back at history.
That's where the most money's to be made, right? You know, he's trying to
taking that risk
and picking the bottom effectively.
Seeing what you're seeing here, right? Like especially the first chart we looked at, which was overweight equities bonds. Like, is that insightful to you at all? Does that tell you anything, or do you feel like that's not relevant?
100%. You know, it's a great fear and greed.
It's extremes, right? That's all it is.
Extremes. And you know, the question is, are you in the market enough to understand? Hey, is there significant value to be had here, right?
But doesn't it go back to your time horizon as well? Like if you're trading weekly or monthly, these choppy waters, maybe that's good for you. But if you're early 40s, mid 40s, late 40s, 50s, whatever, and you've got a horizon of the next 10, 15 years, don't you think that's a very different...
100%. I think it's worth at least dipping a portion of your portfolio and sort of building up that base, right? And saying, this could be the bottom, right?
But isn't that more about asset allocation rather than trying to time markets?
Well, that's right. And we've seen that in the rise of ETFs, where it's time in the market that is producing long-term returns.
I feel like people go out there and with pieces of wood and hammer and nail and start trying to build a house with no plans.
Yeah, that's right.
Like, what the fuck are you doing?
100%. And again, it's fear and greed, right? People see, hey, there could be an opportunity for some outsized growth. Let's just go in and basically gamble and not have a proper plan in place. And you saw that with crypto. You see it with there's a lot of private investment vehicles that are promising crazy returns, and people aren't necessarily having a plan or doing the due diligence to build up a complete portfolio.
I saw sponsored ads coming up on my social media. I think it was out of Abu Dhabi, 20% per annum guaranteed. I'm like, what? Wow. So there is there's all of that, obviously.
Speaking of that, there was a big scandal in the papers the other day about some Deloitte partners getting caught up in a big $60 million private placement for building rural infrastructure in India.
All right.
So it was again promising outlandish returns. Sort of 39% guaranteed returns in 6 months. For buying sort of Indian rural bonds, and it was
and what happened?
It was a Deloitte partner, and he's disappeared. So he was living up in Sydney. He was renting there, no assets in Australia, and he's disappeared. Boom, gone. And I think one of the main touted investors was the new head of Deloitte, who he was banding off the name. So all the other partners got involved. So.
I did see that. Yeah. I just realised. Yeah,
so
when he was using the CEO's name to lure
in all the other investors. Yeah. So sometimes if it sounds too good to be true, it often is.
Yeah. Let's move on. What do you got?
Look, I think a big one following on to this is where's the growth? Where's the growth coming from? Over the next decade, right? And if you're looking at what sectors are coming online that are, number one, going to help humankind as a whole, and number two, and going to increase our efficiency, and increase our effectiveness and deliver growth. And there's some really interesting ones, and I think the biggest one on my mind, I know you love using it, is ChatGPT and artificial intelligence and generative artificial intelligence. There's been some really rapid developments recently where now it's becoming such a powerful tool, and you can see that there's a use case in it. And I've never been so excited about something since, Google search engine, right? And being able to do all that. And, so there's been a lot of focus on this from, the East and the West, and now China's really getting involved in it. And there's almost a race for supremacy in that realm of technology. And there's an interesting article in Bloomberg this week talking about China's chatbot advantage may come from a dark place. So they're really going hard at building out a similar capability to ChatGPT. You've got Baidu over there who are, they're debuting a bot based on their Ernie platform. Alibaba is now conducting internal tests for a chatbot. There hasn't been this level of competition, I feel, since, the Great Firewall and, search engines basically being evicted from China. And so, it's sort of a race in this new frontier, and, this explosion in innovation around the industry is, I think, going to generate a lot of growth and a lot of disruption for businesses. It's quite interesting. You think about the 1900s, and innovation sort of came in the form of telephones, automobiles, electricity, and I think we're now converging on another great wave of innovation that's going to really transform industry. You're looking at robotics, AI, blockchain technology, energy storage becoming super efficient, right? And there's exponential growth in that, which means that, before long, we're going to have autonomous taxis, which is going to be a combination of, better EV battery storage, robotics plus AI, right? Developing out something that's, going to really transform that industry. So it's really, really exciting. In my view, there's a lot of use cases for it as well, right?
What's the opportunity though? Like, how do you? Because presumably it's not something that you can go and like invest in, right?
Well, I think there will be, a wealth of new sort of industries sort of springing up from it. New businesses that are set up based on
like that's the platform, and because of that, it's or either a consequence of the benefits are going to be a whole bunch of things, which we don't know what they are.
That's right. Yeah. That's right. And it's going to be really exciting in terms of investment opportunity and, the next wave of, your big FANG companies that spawn out of this.
What does that mean for, obviously with GPT and OpenAI, Microsoft's involvement with those guys, Google's bit of a
failure with Bard.
Yeah, a bit of a flop with Bard or Baird, however you pronounce it. Like, and then I think the stock fell like 8% on that day.
$100 billion or something.
Yeah, like what implications do you think that has, if any, to the likes of Microsoft, Google?
I mean, they're seeing that they need to get on the front foot with this as well, don't as evidenced by their investment in the sector, right? They're pouring significant funds into developing this out because they're seeing that, this has, major implications. I mean, you can automate all your customer service, all your support staff and tasks. You were telling me the other day about how it can record all your meetings.
Yeah, that's Microsoft Teams. So there's a paid version of Microsoft Teams. I think, $7 or $8 a month. And because of the integration with ChatGPT, they integrate the ability to now transcribe meetings, audio to text. I mean, that's not like groundbreaking. Otter already does that.
But what you were saying was you can actually, it will set task and action items.
It'll then create tasks and action items post-meeting.
I think that's unbelievable. That's if it can automate that, think about the efficiency of, how meetings can be run, right?
Yeah, look, 100%, but I don't think Google's going to sit there and go, all right, well, Microsoft have done it, so let's move on to something else and let Microsoft have that slice of the pie. Like, I just don't think that that's going to happen. I think Google are going to do whatever they need to do to integrate whatever AI system that they need to integrate into Google in order to maintain market share.
Yeah, I think, look, a big one is, I guess, linking in then the network effect, right? So, there's there's a cost to shifting from platforms. So once you're used to it, for example, using Zoom or using Microsoft Office or Word, I mean, you're going to be pretty loyal to that platform, and there's a network effect that builds up as more people use it. Suddenly everyone's using it because everyone else is using it, right? And I think that's a big one. So being able to corner out that market share and having that network effect and early movers and being an early mover and cornering out that sector of the market, suddenly it's, not so worth it for other companies to come in and try and compete.
So I just quickly looked up the stats, Gmail versus Outlook. Take a guess as to how many users. I'll put into perspective for you. Outlook has 400 million users using their platform. How many do you think Google has?
Billion.
1.5 billion.
Yeah. There you go.
Like, do you think a billion users are going to move to Microsoft just like that because of the AI?
I don't know the answer to that question, but yeah, it's an interesting one, and there's going to be a lot of competing factors. All right, there's so many use cases for it that I'm just so excited about it because you can really do a lot with it.
So tell me, like, the different AI programs, if I can call them that, like, does Microsoft's version different to Google's version to different to Baidu's version to?
Yeah, I mean, there's going to be an
like,
AI
who's inputting the
for
data?
everything. Well, that's a problem. So with this Bloomberg article saying, well, while it's impressive that ChatGPT can do all these things, it's only as good as the data that's put into it. So the key here is bad data. It's basically scraping the whole internet for data to give you the best in what it thinks is the best outcome for whatever inputs that you've requested from it. And what they're saying is actually you've got potentially people in the East, in China, that are spreading misinformation or disinformation into the web to
uploading that onto the internet.
Uploading that onto the internet to purposely confuse these AIs and
let's just fuck with it for a little bit.
to build the wrong outcomes. And that's going to be really interesting because obviously China. There's a few internet players there, and Beijing's got a really big history of information control and managing the narrative.
But can't the US exclude any data that's coming out of China, for example?
Yeah, I mean, they could, and they obviously have their own audit and data screeners that are scraping the data to making sure that that's accurate. But as things go on, there's I don't know how scalable that is to be able to, have a manual check to check the veracity of information in the Western world, right?
I feel like it's going so fast. Like, regulators were trying to regulate digital currencies, and then that thing's it feels like that's just disappeared. Like, no one cares about digital currency anymore, and the regulation of digital currency. People are still, entertaining themselves with cryptocurrency. I feel like that narrative's just in the recycling bin for the moment, and now it's this, and now everyone's talking about how do you regulate this? How do you
monetize it?
Governance.
Who actually they're scraping all this data from the internet to give you a solution. If they're charging you for that solution, is there some sort of IP from the rest of the internet that should get a cut of the revenue generated out of that? So it's a really interesting discussion, and I don't know the answer to that. And they're going to have to sort a lot of that sort of stuff out. How they're effectively paying companies for that type of information.
Yeah, I saw. Did you see that quote from Elon Musk the other day? He came out and talked about how bad AI is for humanity. Did you see that?
No, I haven't seen
that.
So
he founded OpenAI, but I don't believe he's with the company anymore. But it was just really interesting to hear his comments on what his opinion is of AI. I would have thought he would have been more supportive of it given his sort of background and what he does. But yeah, it was quite the contrast, actually. That was quite surprising for me. Let's move on. Do you want to chat anything about anything else about that?
Oh, it's just more. It'll be interesting to see how fast this sort of technology is adopted. And, I think in China, from my sort of experience, things get green-lighted there a lot quicker, and technology gets integrated and adopted a lot quicker. So I think we'll see, some really exciting things happen in that space, and some great adoption.
And that's the bottom line. I think for me, I think like what you said's perfect, because it doesn't matter what's going on in the world. Inevitably, there's always going to be something that sort of sprouts out from nowhere, and everyone's like, "Wow, we didn't even think that was possible." And then it sort of generates, I don't know, whether it's confidence or belief or something else in the world that people just have a sense of belief and can look forward to something that's bigger than what it is today. So I don't know. That's why I feel like I'm seldom doom and gloom, because you look back thousands of years, the evolution and progress of humanity is, I just don't think you can stop that.
Yeah.
Had a couple of things on director's cuts, but just in the interest of time, probably skip that. Let's wrap up with tips and recommendations. I don't know what your notes are on about, but why don't you go first?
I've been looking at a website called Masterclass. I don't know if you've heard of this.
No.
So Masterclass gets the best and people in each industry. So, you've got Natalie Portman teaching.
Oh, yes. This has come up on my ads.
You got Stephen Curry teaching you, mindset, psychology, and basketball strategy, right? And I've just found that an amazing
Have you
resource.
Subscribed?
Yeah, amazing resource to see, how the best in class in every industry thinks. And they give you their masterclass. So they give you it's really structured in terms of, there's a whole workbook in terms of, the topics and how they go through things.
So it's quite structured. It's not like you just go there, watch a video.
No. It's a really, structured and short. So there's short clips for each section. And I'm doing one with Thomas Keller at the moment, which is, he's the owner of the French Laundry in California. And he's a James Beard Award winner. So, it's kind of like the Michelin star in the US. Every day I'm just looking at a new recipe that he sort of cooks up. So lobster mac and cheese was last night.
I was like, what the fuck is the lobster mac and cheese?
And oh man, it's great.
How do they get all these stars? Naomi Campbell teaches modeling fundamentals.
It's fantastic.
Michael Pollan on intentional eating.
Yeah, I assume they give them some sort of royalty or cut from
however many downloads.
That's right. Whoever views it, and it's the production value as well. They've done a really great job.
Oh man, the videos look impeccable.
Yeah, it's amazing. So I can't recommend it enough. People should check that out.
All right. Well, I'll have to check that out. Actually, you're gonna have to give me a login, unless they do a bit of a Netflix and sort of manage password sharing.
How about you? What have you been looking at?
All right,
recently?
so Deb and I finished 2 seasons of White Lotus. Have you seen it?
Yeah.
Oh, you have? Yeah. Oh, sick.
It's crazy.
So for listeners, if you haven't seen White Lotus, it's on Binge. HBO have produced it. And so you know what it's about. Yeah. But for those that don't, it's like 7 episodes or 8 episodes a season. And both of the seasons basically start with a bunch of rich white people going on a boat and going to this luxurious resort called the White Lotus. Season 1's in Hawaii. Season 2 is in Sicily. And it always starts with someone dying. Off the bat, someone dies. You don't know who it is. You don't know the context of the background, but someone dies. And then it sort of goes back 7 days ago. And how would you describe it? It's like, it's a bit of a comedy.
It's a dark comedy.
It's a dark comedy.
Yeah.
There's some funny...
it goes into sort of stereotypes of
100%.
Of people and behavioural stereotypes and how that evolves.
It's funny, Deb and I have been in situations where like, oh my God, are we becoming like White Lotus people? I'm like, don't be rude to that guy. Like, be nice to him. So I couldn't recommend enough. They're about an hour an episode. So, download Binge, you get 2 weeks of free streaming. You can watch both seasons for free in the 2 weeks. You got to watch at least one every night. What would you give it out of 10?
Probably 8 out of 10. I really enjoyed it.
I really enjoyed it. I felt like there was no point to I'm like, what's the point of this? I felt like there was, not much of a purpose. It wasn't sort of mean, it left you on a bit of a cliffhanger to work out who died and why and all of that.
Yeah.
Season 2 was like, whoa, how did that happen? But if you haven't seen...
It's more of going into human behavior and sort of, you know, if you put yourself in the shoes of the people in there, would you have done the same thing, you know? And would you have reacted the same way? And I think that's, for me, the human aspect of it, and going, wow, geez, you know, people can react in funny ways when situation dictates, right?
Yeah, 100%. Yeah, well, you just don't know. I mean,
it's like a lab experiment almost. You've put all these people in this place where they're holed up, they can't leave.
But it is really interesting where you can see so many like behavioral traits to people when you're in that situation, you're in a heated argument or something didn't go your way, you act in a particular way and you rationalize it with a narrative so quickly in your mind that you make it seem okay for you to do whatever you've done in that situation 100%. Because he did this, so I can do this.
Yeah.
You know, if you remember the very last one of the last episode in season 1.
Don't ruin it for everyone.
No, I won't ruin this. Where the kid. Well, if you're going to watch it, just put on mute or something. No, put this on mute if you're going to watch The White Lotus. But you know, with the kid of that family with the sister who brings the friend, they're just doing drugs.
Yeah.
And he wants to stay in Hawaii. Like he just seems to me like this kid that's had like no love from his parents. His sister gives him shit all the time, and he's basically a loner in the family. And he has no passion except for gaming and screens on his phone. And then in the end, he wants to stay with these Hawaiian dudes and row every morning. And I'm like, let the kid stay.
Yeah,
what are you doing? And the parent's like, you are not staying in Hawaii. You are coming home with us. But it's so interesting as a third party how you can observe and look at things from a far less emotional perspective. And I think that's really important, like whether it's investing or whether in life and life decisions that, I don't know, somehow you can maintain that. It's bloody hard, man.
The wide lens.
Yes. No pun intended, right? Like if you can maintain that, it's bloody hard though. Like that's why we are what we are and that's what we do.
That's
what we
right.
do.
100%.
All right, let's wrap up. Jump on YouTube, subscribe so you get this straight notification once we have these pushed out every single week. Any comments, question, hit us up, info@baharianwealth.com.au, and we'll catch you next week. My name's Robert Baharian, and I'm the founder and CEO of Baharian Wealth Management, AFSL 526798. The information contained in this podcast by me and or our guests may include general advice and does not consider your personal circumstances. You should seek personal advice from a registered financial advisor who can consider whether the general advice is right for you.